Let's jump right into this explainer, folks, because today we are absolutely tackling one of the most frustrating and honestly, the most expensive traps pretty much every trader is faced at some point. I mean, if you've ever meticulously mapped out a trend line, totally convinced you found the perfect setup only to just watch your money vanish, well, this breakdown is 100 for you. Today, we're fixing those common trendline mistakes and giving you a detailed explanation on exactly how to combine the stochastic indicator with those trend lines to make them incredibly powerful. You've probably lived through this exact scenario. You're watching the charts and you see the price driving straight toward that line you so carefully drew. You're thinking, okay, this is it. It's touching the line, it's definitely gonna bounce. So you buy in right at that exact moment, but then boom, no way. Instead of bouncing, the price literally slices right through your trend line like a hot knife through butter, and immediately triggers your stop loss. It hurts, right? The harsh reality we need to accept is that blindly predicting a bounce just because the price happened to touch a line on your screen. Yeah, that's practically the fastest way to completely drain your trading account. So to fix this, here is our roadmap for today. First, we'll cover the problem with trends. Second, the absolute most accurate drawing method. Third, the stochastic indicator secret. Fourth, the perfect entry point. And finally, number 5, a rock-solid capital management strategy. Alright, moving right along to section 1, the problem with trends and specifically the whole bouncing versus breaking dilemma. So, the absolute biggest hurdle traders face is the confusion between actually predicting a bounce and just relying on subjective drawing. I mean, think about it. If you hand the exact same chart to 10 different traders, I guarantee you'll get 10 completely different trend lines. And that brings us to the classic debate. Should we be connecting the candle wicks or connecting the candle bodies? You know, some traders will swear by using wicks to get the absolute extremes, while others are totally rigid about only using bodies for the true closing price. But you know what the golden rule actually is? It's simple. You just choose whichever method gives you the maximum number of touch points on the chart. That's it. If connecting the bodies gives you 5 touches, but the wicks only give you 3, then the bodies are the correct choice for that specific setup. The ultimate goal here is always maximizing those touch points. Let's transition into section 2, the most accurate drawing method, because we really need the right foundation here. The truth is, you simply cannot build a solid house on a shaky foundation, right? Without the proper setup, literally even the best indicator strategies are going to fail miserably. So, this brings us to a massive mindset shift, and I really want this to sink in. Trend lines should be treated like areas or zones instead of fixed lines. Actually, let's repeat that. Zones, not fixed lines. So many traders demand absolute perfection, expecting the price to touch their line down to the exact pixel. But come on, the market just isn't that rigid. Having a wick pierce through, or maybe slightly miss the mark, that is completely normal, as long as the price stays within the general zone of those major swing points. Giving your charts this flexibility is exactly what keeps you from getting faked out. Okay, building on that zone concept, here are the mechanical steps you need to draw a valid line. Step 1. Identify the major, incredibly obvious swing points. You're looking for those sharp, absolutely undeniable V or A shapes on the chart. Then step 2, connect at least 2 of these major points. And step 3, maximize your touch points, just adjusting the line to include wicks or bodies as needed. Now, I'll be honest, spotting these swings does take a little bit of practice initially, but I promise it becomes second nature over time. Okay, here we go with section 3, the stochastic indicator secret, which is basically our ultimate filter. This right here is where the magic really happens, because we are getting into the detailed explanation of combining the stochastic indicator with your trend lines. Think of your trend line as the geography, right? It shows you an area of interest on the chart, but, and this is absolutely crucial, it tells you nothing about the market's energy. That is exactly where the stochastic indicator steps in. It's defined as a tool used to identify overbought and oversold levels, giving you that extra confirmation to actually validate a bounce. So when the price approaches your trendline zone, you don't just blindly buy anymore. No way. You look straight at the stochastic to see if the energy behind the push has exhausted itself. It is the missing puzzle piece that gives you the win to your trend line's wear. It acts like a real-time momentum lie detector to keep you out of those painful breaks. So how do we use it? Let's look at section 4, the perfect entry point for our methodical execution. Let's walk through the exact sequence you need for when momentum perfectly aligns with your geography. It goes like this. Step 1. Price enters your trend line zone. That's your geographic area of interest. But remember, don't panic, and definitely do not enter yet. Just watch. Step 2. Check your stochastic momentum gauge. You want to see its signal line push deep into oversold territory if you're looking to buy, or overbought if you're looking to sell. And finally, step 3, which is your actual trigger. Wait for the stochastic to cross back inside those safe levels. This specific crossing action proves that the momentum has finally shifted, and it aligns perfectly with your geographic trendline zone. Boom. That right there is your methodical, rule-based entry. And oh man, here is a massive bonus factor for you. Confluence. Think of confluence like a giant brick wall shield on your chart. Imagine you have your trendline zone and your stochastic trigger lined up, but then right at that exact price area, it also perfectly aligns with an old support level that has recently turned into resistance. That is confluence. When you have multiple key levels converging at a single point like that, it drastically increases your probability of a successful bounce. You have essentially stacked the odds entirely in your favor. Alright, bringing it home with section 5, capital management strategy, because we absolutely have to protect your account. Listen, a sky-high win rate means absolutely nothing if a single careless loss wipes out 10 of your wins. The ultimate goal here isn't just finding a perfect entry, it's long-term survival. So here are the strict risk management rules you must follow. First off, always place your stop loss slightly beyond the nearest swing point or just outside your trendline zone. Why? Because if the price actually breaks that point, your entire thesis for the trade is wrong and you need to get out immediately. No hoping, just out. Second, set your take profit at exactly 2 times the size of your stop loss. That gives you a solid 1-to-2 risk-reward ratio. Disciplined execution of these specific rules is quite literally the only thing separating a professional trader from a gambler. So we've covered the complete blueprint today. We went from diagnosing the trap to detailing exactly how to combine the where of your trendline zones with the when of the stochastic momentum indicator. So here is the big question you need to ask yourself right now. If you adopt this zone mindset, stop blindly clicking buy just because a price touches a line, and instead patiently wait for that stochastic trigger, what results will your next chart bring? I highly encourage you to open up your platform today, draw those zones, and test this incredibly powerful combination for yourself. Thank you so much for joining this explainer. Stay disciplined out there, and happy trading.